In sophisticated financial modeling, the gross return is often treated as the primary benchmark of success. We celebrate a 10% annualized gain as a finished product, a static trophy of market outperformance. However, for the private investor, gross return is merely a theoretical starting point, a raw number that has not yet been subjected to the realities of the fiscal environment. The true measure of a portfolio's efficacy is its tax-adjusted return. Tax leakage represents the quantifiable degradation of wealth caused by the realization of capital gains, the accumulation of non-qualified dividends, and the friction of high portfolio turnover. While market volatility is often a temporary state that can be navigated with time, tax drag is a permanent, non-recoverable loss of capital. To achieve optimal wealth accumulation, an investor must solve for tax alpha, the additional return generated not through market timing or stock selection, but through the strategic minimization of fiscal friction. To master the environment, one must realize that long-term success is defined by what is retained after the final settlement, not what was briefly held on a brokerage statement.
To understand why tax is the ultimate anti-compounder, we must look at the mechanics of investment friction. Every time a tax liability is triggered, capital is removed from the ecosystem of the portfolio. This capital is no longer available to grow, to reinvest, or to participate in the geometric expansion of wealth. Imagine two identical portfolios, both growing at 8% for 30 years. Portfolio A is structured in a tax-neutral environment, such as a Roth IRA or a tax-deferred 401k, allowing the full 8% to compound untouched. Portfolio B is subject to a seemingly minor 1.5% annual tax drag, the typical cost of high turnover, inefficient dividend distributions, and the regular realization of short-term capital gains. Over 3 decades, that 1.5% difference doesn't just reduce the final balance by a small margin. Because of the lost growth on the money diverted to pay those taxes, the final wealth gap often exceeds 40%. Tax is not a simple one-time fee. It is a recurring penalty on the future growth potential of every dollar lost. Investors are effectively fighting a war on 2 fronts, one against market risk and one against the structural friction of their own account architecture.
The investigation of fiscal inefficiency often leads to a phenomenon known as the realization trap. Many investors succumb to the urge to sell high-performing assets to lock in a gain, unaware that they are voluntarily triggering a tax event that resets their compounding clock. This is often compounded by a misunderstanding of Section 1091 of the Internal Revenue Code, commonly known as the wash sale rule. The wash sale rule is a specific legal constraint where an investor sells a security at a loss to claim a tax deduction, but purchases the same or a substantially identical security within 30 days before or after the sale. The technical consequence is the disallowance of the loss. The loss is deferred and added to the cost basis of the new shares. This creates a liquidity trap where the investor has experienced the economic loss but is denied the immediate tax shield required to offset other gains. This creates a net increase in tax liability for the year, effectively increasing the cost of the trade beyond the market price. Conversely, there is a technical risk in being excessively risk-averse regarding taxes, leading to what is known as the lock-in effect. Some investors hold on to toxic, stagnant, or over-concentrated assets for decades solely to avoid triggering a capital gains tax, hoping for a step-up in basis at the time of transfer to heirs under Section 1014. This strategy often results in a massive opportunity cost. If an investor saves 20% in taxes by holding a stagnant asset, but loses 50% in potential growth because they were tethered to an inefficient investment, the math fails. True portfolio architecture requires the quantitative discipline to know when to pay the tax toll to move capital from a low-velocity asset into a high-velocity growth engine. Holding an asset strictly for tax purposes is often a form of concentration risk that can destabilize the entire portfolio structure. While retail investors focus almost exclusively on what they own, asset allocation, institutional wealth managers focus with equal intensity on where they own it. This is the practice of asset location,
the strategic placement of specific assets into specific tax-advantaged buckets to minimize annual friction. Inefficient assets, which are high-yield corporate bonds, REITs, and actively managed mutual funds, produce high levels of ordinary income or frequent short-term capital gains. If placed in a standard taxable brokerage account, they bleed capital every year through high-rate taxation. These belong in the sheltered environment of a 401k or traditional IRA. Efficient assets, which are low-turnover index funds, growth stocks, and municipal bonds, produce very little annual tax liability. These are the ideal candidates for a taxable brokerage account. By failing to perform this asset triage, the average investor effectively pays a voluntary premium on their lack of organization, allowing fiscal drag to skim off the top of their most aggressive growth engines. To counteract this erosion, a sophisticated investor must implement a system of tax alpha, generating excess returns not through superior stock selection, but through the strategic optimization of the portfolio's structural architecture. This is achieved by deploying three primary tools: systematic tax loss harvesting, where an investor intentionally sells underperforming assets during market dips to capture losses that offset the realized gains of winners; the 0% capital gains bracket, which allows those in specific income thresholds to perform tax gain harvesting by selling and immediately repurchasing winners to reset the cost basis to a higher level without incurring a tax bill; and the charitable gifting of appreciated securities, where the investor transfers their most bloated winners directly to a cause. This final move acts as a double-edged advantage, providing a tax deduction for the full market value while permanently erasing the latent capital gains liability from the record. Much like a gardener pruning dead branches to ensure the tree's energy is directed toward new growth, these maneuvers ensure that every dollar in the portfolio is working toward accumulation, rather than being siphoned away by fiscal friction. Wealth building is ultimately a war of attrition. You are not just competing against other market participants or the inherent volatility of the indices, you are competing against the corrosive, compounding power of fiscal friction. While a market crash is a visible, high-impact trauma that captures the headlines, tax drag is a slow internal hemorrhage, a systematic transfer of your hard-earned wealth to the Treasury that occurs every time you rebalance a position or collect a taxable dividend. If you ignore the tax implications of your structural choices, you are essentially running a marathon with a weighted vest. To build true intergenerational wealth, you must learn to treat tax efficiency with the same mathematical seriousness as asset selection. This means shifting your mindset from that of a trader to that of an architect. You must eliminate the invisible leakage of inefficient asset location and unnecessary realization of gains before it drains the life out of your long-term compounding engine. In the final accounting, the market doesn't care how much you made. It only matters what you were able to keep. Efficiency isn't just a bonus. In a world of compounding, it is the ultimate form of alpha. Thank you for listening.